Three, two, one, go. All right, welcome back to Academic Market Insights. Very awkward start, but I think I'm just going to leave it so people will see that we're real people. So today we're going to talk about, as the title tells you, what we're going to talk about the Federal Reserve and what the Fed is, what their functions are. And this stems from my oldest daughter asking me, she needed to learn a bit about the Fed in a very short period of time. I assumed that we had a video. Would you, Dr. Adamiec, assumed that we had a video on the Fed with all the topics that we've gone through? And as much as we talk about the Fed when we're talking, and now I'll stop talking and let you answer.
I would have assumed that we did. I know this is something because we were speaking offline about this, but I don't even think it's really heavily covered in the finance curriculum.
No.
And I know it's supposed to be covered in economics, but it's
Hmm.
freshman level class, and I don't know how much retention is actually happens from that class.
Hmm.
But the Fed's decisions are so important for how they impact our day-to-day lives.
Yeah.
It is something that should be discussed more frequently, I think, in finance classes.
No, absolutely. In fact, I teach equity and fixed income investments at Kelly, and I do think, and I keep trying to bring some more real world things into the curriculum. I think, what the Fed's doing during different economic cycles. I've done my best on it. Luckily, we've been going through a rate cutting cycle, so I have something to talk about. But I try to incorporate it, and I also try to incorporate using the derivative markets to figure out what they may do.
Sure,
Um, but so
absolutely.
it's it, but and there are periods of time where the equity markets are focused on different things. Right now, and we're talking in early December of 2025. In fact, a day before the last Fed decision in 2025. The stock market been completely fixated for about a year and a half on what's the Fed's next move going to be, and generally the sell-offs in the stock market have coincided with instances where the market is pricing in no Fed cut. So stocks are very tied to what the Fed's doing. The tentacles that come out from the Fed, and it really do impact just about every part of finance, including the corporate finance. If you've got to refinance your bonds, what do you think what do you think interest rates are going to be doing in a couple of years when your bonds mature and you've got to issue more debt, et cetera? So
Well, and
it all goes back to them.
it's also interesting how, to some extent, how little it impacts our lives.
Hmm.
So we talk about the rates being cut and it's going to have an impact on mortgage prices and things. But unless it's a big enough drop, you're most likely not going to be refinancing your mortgage because of the costs associated with refinancing your mortgage.
Yeah.
It's an interesting, it's important to think about these things, but also when we start to talk about it, how does it really impact your day-to-day life? And what are the goals of the Fed? So one of the things we're going to talk about is some of the monetary tools that they have, or monetary
Hmm.
policy tools, pardon me. And when we talk about cutting rates or raising rates, we're really looking at how do we stimulate the economy or how do we slow down the economy? And what the impact is about stimulating or slowing down the economy. Because think about it, if we're stimulating the economy and it's cheaper for corporations to borrow, then that hopefully they can start to hire more people. People have higher wages, and then it kind of erodes this inflation issue because right now we have elevated prices and people's wages haven't risen in conjunction with them. So lots of different moving pieces that go along with this, and it's sometimes hard to be able to sort that. With that,
Hmm.
let me open up the deck.
Absolutely.
I think we could easily talk about this for, well, we can talk about it for a
Well,
long
we used to do 3 hour car rides together, and I'll bet you we could spend a whole 3 hours talking about the Fed, but we're not
I
going to do that.
Yeah, I think we can. But I think it's a really important, I know for my students, it's not necessarily as prevalent in the curriculum as it could be. I'm going to
Hmm.
be teaching a personal finance class, and when we go through mortgages, I will hone in on what does the Fed do.
Yeah, and I think that's the main. area that it hits individuals? Because
Right.
that's a question that I get from a lot of graduate students is about refinancing a mortgage or buying a house or, should I lock in a rate right now, et cetera. So that seems to be the main impact of what direction rates are going with respect to Fed decisions.
And, and I know this is off topic, but it's our show, so we can do what we want. But one of the things that we've also talked about is when we think about these rate cuts, we would love to see it in the private credit
Yeah.
industry,
Yeah.
but we're not seeing it there. So it's
Mm-mm.
interesting as we will talk about that. But when we think about cutting rates, we're not seeing credit card rates decline or those interest rates
Mm-mm.
associated with credit cards. So it'd be great to start to see or make lending a little bit more easy or easily accessible to
Mhm.
people through private credit. So today we're going to talk about the main functions, the structure, and those fun monetary policy tools, because those tools are really what get all the attention. So are the main functions of the Fed, and Russ, I'm going to put you on the spot. We talk about this all the time,
Mhm.
the duality of the Federal Reserve. So we have more than what's the duality. So what is the duality? We're looking at, uh,
Oh,
yeah,
monetary
putting you on
policy.
the spot.
Sorry. Oh, I didn't know I was supposed to fill. I didn't know it was a fill in the
Yeah,
blank
no, no,
question.
that's okay.
Sorry.
That's okay.
No. So, the every time, and I love that he does this.
I do too.
Every time Powell starts the press conference, he says, we continue, or like the first or second sentence in their statement is, we continue to focus on our dual mandate of managing inflation and achieving the best employment situation. Of course, now I'm paraphrasing, but and achieving the best employment rate that we can by balancing inflation with everybody having a job. And typically, when you raise rates a bit, that will put a squash on inflation, but might also, unfortunately, result in an increase in job losses. If if with higher rates, things may not be as profitable for companies. Their financing costs, they've got to make up for that somewhere, and unfortunately, personnel might be where they make up for that. Conversely, if the economy looks like it's slowing in a manner that is beyond what the Fed is comfortable with, we should be cutting rates, and that's the environment that we're in right now. There's a huge debate as to whether or not they really should be cutting rates because inflation is still not much, but lurking around a bit, and the economy doesn't seem to be slowing that much. So that argument has me a little twisted sometimes, but they generally signaled that rates are going to continue to go down probably through 2026. And businesses maybe are sitting on the sidelines waiting for money to become a little bit cheaper to expand, et cetera. That signaling part is a big part of promoting the financial stability as well.
And it's interesting as we're talking about cutting rates, and that'll stimulate the economy and different companies waiting to be able to start making those investments. What can happen, and this is something that's a little uncomfortable to talk about, but I think it needs to be put out there, is that if we continue to cut rates aggressively and we really overstimulate the economy, what will happen is we will eventually have a bust. So the
Yeah.
economy will start to do very well, and eventually something will crack. And that's when recessions happen. That's when depressions happen. So if you're just tuning in and have never thought about the Fed before, part of promoting financial stability is to make sure we don't really have deep troughs or too high peaks.
Yeah.
We want things to be growing at a slow, steady pace so that we don't have either of these extremes. But they do other things, such as
Yeah.
regulate banks, make sure there's efficiency within the payment system, and manage the US Treasury. If you've ever seen anything, documentaries on managing the US Treasury, there's lots of debate about the validity of some of this. That is not what we're going to be discussing today. We're going to be more focused on that promoting financial stability. Okay, so the structure, because this is always neat, the Board of Governors, and then we also have our regional Federal Reserve banks, and then the Federal Open Market Committee. And correct me if I'm wrong, but I believe the FOMC, that's who's meeting tomorrow, and they're the ones who eventually make the decisions whether or not we're going to raise or cut rates.
Correct. And there's so all of the regional presidents will be
Now,
at the meeting, but not all of them are voting members. Sometimes you'll hear, right now, just in this as an example, but right now, the Feds, they've pretty much signaled that they're going to give us a 25 basis point cut tomorrow. If there's a Fed governor that's out there saying, I don't agree with the cut in a speech or something like that, you will often see when they're being quoted as to whether or not they are a voting or a non-voting member, because the voting members do carry a little bit more weight. There's, t I think the turnover is four voting members every year. This December meeting will be the last meeting for four of the presidents that are voting, and they will be replaced by four other regional presidents. I don't know all the specifics on it, but I do know that the ones that are coming on have different opinions as to what we should be doing as opposed to the ones that are going off as far as voting members. And that's part of the market kind of being braced for this final Fed decision of 2025.
and with the reserve members, those banks, they rotate in and out for who's a voting member and
Yep.
who's not, except for the president of the New York Bank,
Of
the New
course.
York Federal Reserve. They always have a voting vote, always are a voting member. So the president of the Chicago Federal Reserve Bank will sometimes be a voting member and will sometimes not be a voting member. Okay, so there's different regions. There are 12 overall different regions, and they were structured. I think the Fed was started in 1913, and they were structured based on the demographics of the time.
Yeah.
So I know that there's been rumblings of changing some of those structures, but I don't know that that will ever actually happen.
You're not bad-mouthing Cleveland, are you?
I'm not.
Okay. No.
I should also put out a little heart. I really, really, I mean, I'm Chicago, love Chicago, but I really like the St. Louis Fed.
Oh,
Um,
because of the data.
because of the data.
Yeah.
I think most academics would also have a slight crush on the St. Louis Fed. They house the Federal Reserve Economic Data, the FRED database,
Mhm.
which is a great database and free to use. So highly recommend it for those who are interested in Fed data.
Mhm.
So tools at the Fed's discretion: open market operation, interest on reserve balances, the discount rate, and the reserve requirements. Let me see. Let's go into, and that was it. But let's very briefly talk about the reserve requirements because we're not going to talk about it again. The reserve requirements was a requirement that banks had to have a certain amount of cash on hand
Mhm.
every night. And if to slow the economy down, what the Fed would do is raise those rates, and then that would force the banks to have a less risky portfolio of assets. And if they wanted to stimulate the economy, they would lower that reserve requirement so the banks could lend out more. That tool has become almost obsolete. I think it's been around 0% for a long time,
Yeah.
and it hasn't really been employed by the Fed. When we really think about the Fed's open policies, it is that changing of interest rates. The Fed also has the opportunity to control the money supply. So this control of the money supply comes from how many bonds they're going to be issuing. So when they issue more bonds, it's called, depending on the size of it, but potentially flooding the market
Mhm.
and gives more money into the market, which allows for an expansion of the economy. When they start to buy back some of those bonds, that's going to contract the economy and slow it down. But what we really think about is setting those interest rates. And this is my personal experience. So I worked for a GSC, a government sponsored entity, the Federal Home Loan Bank of Chicago. And my job was to create tailor-made fixed income products for our top lenders. And we would borrow directly from the Fed, and then our lenders would borrow from us. So those changing of interest rates then would dictate how much we were lending to our top clients. And those banks, like at the time, it was ABN AMRO, which was now bought out by US Bank, but they would then go ahead and then lend out money for the small businesses, sometimes larger businesses. I don't know that US Bank worked with individuals, but that the chain would be commenced. And again, how much we had access directly to the Fed would then dictate how much or what the price was that we were then sending out the door to our clients. And that spread, the little amount, the difference between what we charged and what we got the money for was where the profitability would come from on our balance sheet. And then that became that spread from what the top lenders would get from us and end up sending to small businesses. That spread is how those banks become profitable.
And
Yeah.
what you're describing, from from kind of a professional level there of creating the loans,
Mhm.
that more and more banks have veered away from just trying to get people to deposit money with them and just, using cash from the Fed to lend out at a slightly higher rate and try to make money off of that spread as opposed to and we're both on a radio program periodically where the main grumpy guy likes to badmouth what the banking system has become, but the large multinational banks that most of us have our checking accounts at, et cetera, they're not really profiting from traditional banking activities, which is taking deposits and paying a rate on it, and then turning around and lending that money out at a higher rate. The borrowing from the Fed seems to have taken over the borrowing from individuals.
Well, and we're unique liabilities, right? So all of our deposits, and that's something else that I feel like is not really honed in a lot in financial curriculum. When we think about what are the liabilities of a bank, so if you're looking at the balance sheet, the liabilities are all those deposits. It's a unique challenge, right,
Yeah.
of banks. And since it is almost Christmas time, the movie It's a Wonderful Life, the whole premise is around this idea that there weren't enough assets in the bank to cover those liabilities for when there was a bank run and people started pulling their money out of the bank. And there was a time period where banks would go under because of this.
Yeah.
So from a operational risk standpoint, those deposits don't necessarily make as much sense as working directly with the Fed or another GSE.
Exactly.
And I think that is all we have for our introduction to the Fed. I hope we do more Fed videos because I would love to go into the description from the economic side about what happens to the economy as we flood the market with these bonds and flood the money supply or restrict the money supply. And I know everybody loves to look at the supply and demand graphs,
Of
right?
course. So,
Good.
and I do think that maybe the Fed gets a little lost. I'm in as far as what to do with them in the academic world. I'm planning like a 2-day class for Kelly in Chicago in June, and part of what we're going to be doing is going to see the Fed. I'm taking an econ professor along for that part, just because that's more of his area than it is my area. So we're kind of co-teaching it. We're going to do, Federal Reserve, what they do in Chicago and what the exchanges do in Chicago. But it really is kind of academically outside of the finance area. But my goodness, does the Fed activity impact what happens within the finance world?
Everything.
Yeah,
Everything. I had a buddy who traded fixed income, and he would say, days that the Fed would either issue more bonds or buy back bonds. He's like, it was like you were in a sand pit or a sandbox, and all of a sudden the gorilla showed up. He said, on those days, you just got out of the sandbox.
Just
You
got
don't
out of
play.
the way, let them do their thing. Yeah, I could see that.
Yeah.
So there.
So with that, if you enjoyed this video, please hit like. And if you are not a subscriber, please subscribe. And we just thank everybody for joining us and participating. And if you have any questions or comments or any thoughts that you have on the Fed, you want to specifically would like us to dive deeper, you can't wait to see the supply and demand graphs. We can't wait to give them to you. So just let us know, put them in the comments. We just thank you so much. Thank you.